The supervisors in the individual member states didn't do their job. When you eat up the equity base is when you have to start looking for whom else is to pay.
On October 18, EuroFinUse, the European organization dedicated to defending the rights and interests of users of financial services, held its second international conference in 2013, following the highly successful conference on the audit reform earlier in the year, featuring the European Commissioner for Internal Market and Services, Michel Barnier. The conference on the financial repression of savers and investors drew more than 60 authorities from the private and public sectors to discuss the alleged inevitability of financial repression and countervailing measures to stop the impoverishment of European savers and investors. Most of us don't know it, but we now live in an age of financial repression. The term denotes the combined set of financial policies that allow governments to keep real interest rates low or negative and coerce a captive market into investing in government bonds. This allows governments to continue issuing sovereign debt at an artificially low cost, obliterating the real value of people's savings in the process. This controversial topic provided food for a lively debate, since it is European pensioners and small investors in particular who feel the full blow of financial repression.
The goal of the conference was to check whether there is in fact financial repression, and yes, I thought there was, but I think now there is consensus that there is in fact financial repression against all European citizens.
It's probably the first time that financial repression has been the actual subject of a conference. We talk a lot about all of our problems, but this is a specific angle, and I think it was therefore interesting. It brought out one or two aspects that needed to be brought out.
I'm very, very glad that so many people came and that we had a lively discussion.
Financial repression is often described as any of the measures that governments may employ to channel funds to themselves, and that, in a deregulated market, would go elsewhere. In light of the current financial crisis, the purpose of financial repression is to enable governments to repay national debts accumulated since the end of 2007.
Financial repression thus takes many forms. Artificially low interest rates, increased taxation on nominal investment income, while inflation is already eating all your remuneration. What a nice way to reward the small savers and investors who have successfully managed their budgets, which is not the case of our politicians.
Essentially, it's about bringing fiscal revenues into line with fiscal expenditures. Now, in some countries, that has not been entirely through the profligacy of the government. It is also because the government, i.e. the taxpayer, has taken on the debts of the banks.
Financial repression is letting money go to the places money would not go otherwise, so it's an inefficient allocation of money, which is bad news for economic growth, which is always a bad news, certainly now when we face very strong headwinds in that field.
We have to get used that we have low interest rates, that we have inflation rate, that it's higher than the interest rate, yeah? And so we start to realize what does it mean.
Nobody will ever say we are creating an institution for financial repression. No, we are, the ESM, European Stability Mechanism, is there to save the euro. ESM has the mandate to buy bonds from euro area nations directly, first-hand. And the European Central Bank has the mandate to buy bonds of euro area nations on the secondary market. And they even want to do it unlimited. So financial repression is not only a fact of life. We have moved into a new phase. We are setting up institutions for financial repression.
Pension funds, insurers, and bankers will continue to be hard-pressed by governments to buy into sovereign bonds, and since these offer low or even negative real returns, funds will eventually deplete. So how can we avoid financial repression? Panelists, speakers, and participants all looked for ways to introduce some countervailing measures to counteract the perverse effects of financial repression and lighten the burden for small investors, pensioners, savers, and European citizens as a whole.
What we can do is stop lying to consumers and retail investors and telling them first to give them figures in real returns after inflation, so they know, they see that they are losing money, so they know that they are paying for something, and also to provide an alternative which is a long-term, low-cost, simple investment product that we will provide them with, over the long term, with a real positive return, but also, even more importantly, will help European economy restart, and create jobs, help SMEs, etc. And we strongly believe that this has to be found around a very old product, which is the best suited for this, which is called shares, which is called equities.
I think there are savings products that could be developed where there is relief on tax paid on the interest, because savers usually are saving from income that has already been taxed. They are getting almost no interest on their deposits, and they also sometimes get taxed on the interest that they do earn.
Crowdfunding allows us to invest in SMEs, small and medium-sized enterprises, which account for 99% of all businesses in Europe, and which have no access or very limited access to bank finance or equity finance.
With this difficult environment, authorities are doing things to address the crises. If you want to call it financial repression, that's fine with me.
Three central questions were at the heart of the conference. First of all, is there financial repression? During the course of the conference, a clear consensus emerged amongst all participants that yes, financial repression is a fact. The answer to the second question, what is the impact of financial repression, is less straightforward. But also for this question, clear answers emerged from the conference. On the positive side, it was shown that the debt burden of certain governments is shrinking. But on the negative side, financial repression is at the root of two bad developments. First, all savers, institutional as well as individual, are losing money. In short, individual savers are being punished for doing the right thing, whereas the people responsible are not. And two, financial repression leads to the inefficient allocation of money, thus lowering potential and actual economic growth. Money is essentially being driven into the acquisition of government bonds and not into the real economy. This inevitably led to the third question of the conference, whether anything can be done to alleviate the burden of financial repression. And whereas a lot of answers were provided, one was reiterated over and over again and echoed by most participants at the conference. It is time to go back to basics and return to simple, low-cost, long-term saving products. The good news is that there's one product that was invented a very long time ago. It is called equities.